Welcome to Pipeline Trading. This is the ultimate beginner's guide to everything you will need to understand technical analysis. Make sure to pause in between and watch over certain parts so that you fully understand the basics. I'm a professional trader, venture capitalist, and former private equity investor. Over the years, I have navigated the markets, analyzed hundreds of companies, and developed strategies that consistently work. In this video, I have put 20 years worth of knowledge together and broken down all the basics for you to grasp and build a solid foundation so that you may continue to grow. You will learn candlesticks, how to identify trends and market directions, volume, understanding, price action, patterns, indicators, and most importantly, risk management and emotional discipline. Before we dive into specific candlestick patterns, it's important to understand why prioritizing price action over indicators is crucial. Indicators often lag price movements, which can lead to delayed trading decisions and missed opportunities. Trading price action concentrates on immediate market analysis, enabling traders to respond quickly to fluctuations in price. With that in mind, let's start with green and red candles, the building blocks of price action. Understanding these is essential for analyzing price movements and making informed trading decisions. Green candles represent bullish sentiment in the market, indicating that buyers are pushing the prices higher. Red candles signify bearish sentiment, indicating that sellers are driving the prices lower. A candlestick is made up of 4 essential components: open, close, high, and low. The body of the candlestick represents the price range between the open and close prices. The wicks show the highest and lowest prices during the candlestick's time duration. Now that we understand the basics of candlesticks, let's explore continuation patterns which help traders identify when a trend is likely to continue. The bullish mat hold pattern is a rare 5-candle formation that signals the continuation of an uptrend. It consists of a large bullish candle, followed by 3 smaller candles that form a brief, consolidated pullback without dropping below the first candle's low. Concludes with a 5th large bullish candle that breaks to a new high. This pattern shows that buying pressure is resuming after a temporary pause, making it a buy signal for traders to enter a long position. Next, we have the on-neck and in-neck patterns. The on-neck pattern consists of 2 candles and appears during down and up trends. The initial candle is a long red candle, succeeded by a smaller green candle that opens lower but closes around the low of the preceding candle. The in-neck pattern is similar, but here the second candle closes just above the low of the previous candle without surpassing its closing price. These patterns indicate that the market may be trying to reverse, yet the bears still hold the upper hand, suggesting a probable continuation of the downtrend. The advanced block pattern tends to be more dependable over extended time frames. As the candle periods increase, the likelihood of a significant reversal also rises. Always wait for a confirmation candle before initiating a trade to prevent false signals. The pattern does not need to be flawless, for instance. The second and third candles may not consistently be smaller than their predecessors. But the crucial aspect is that they face difficulty in driving the price upward. When engaging with 3-method formations in trading, it is important to recognize that they often suggest a potential continuation of the existing trend. The bullish 3-method formation serves as a cue to either buy or maintain long positions, as it indicates that the upward trend is likely to persist. Conversely, the bearish 3-method formation acts as a prompt to sell or keep short positions, signaling that the downward trend is expected to continue. Nevertheless, like all trading strategies, it is advisable to use these signals alongside other technical analysis tools to achieve optimal results. Now that we've covered continuation patterns, let's shift our focus to momentum patterns, which help traders gauge the strength behind market moves and confirm trends. A bullish big body candlestick occurs when the close price is significantly higher than the open price. This indicates strong buying pressure and is generally seen as a bullish sign. Conversely, a bearish big body candlestick occurs when the open price is significantly higher than the close price, suggesting intense selling pressure, and is typically seen as a bearish sign. These large body candlesticks can appear on multiple time frames, from minute to monthly charts, making them versatile patterns for both short-term and long-term traders. Some important features to consider. The body of the candlestick is significantly larger compared to its neighbors. It may have small wicks or none, but having wicks does not invalidate the pattern. The volume during this period should preferably exceed the average volume, supporting the indication of strong market sentiment. Marubozu candlesticks signify a strong buying or selling influence and can be highly advantageous for traders, whether focused on long or short-term trading. A bullish Marubozu in an uptrend validates the strength of the trend, indicating a continuation. A bearish Marubozu during a downtrend reaffirms prevailing selling pressure. A bearish Marubozu appearing at the peak of an uptrend, or a bullish Marubozu at the bottom of a downtrend, signals a potential reversal. The high and low points of a Marubozu candlestick can also serve as critical resistance and support levels for future trades. Shaved top and shaved bottom candlesticks are unique patterns, characterized by the absence of either an upper or lower shadow, or sometimes both. The lack of a shadow suggests strong momentum in the direction of the candle and provides insight into current market sentiment. A shaved top candlestick has no upper shadow, indicating strong bullish momentum, particularly when it occurs at the end of a downtrend or during a continuing uptrend. A shaved bottom candlestick lacks a lower shadow, indicating robust bearish momentum, which is significant when it appears at the end of an uptrend or during a bearish trend. Now let's move on to indecision patterns, which provide insights into potential shifts in market sentiment. Thrusting candlesticks occur when there is a lack of consensus among buyers and sellers. These candlesticks don't necessarily indicate a reversal, but rather a period of uncertainty. High wave candlesticks represent a significant rise or fall in price over a short period, showing a loss of control in the market, often leading to a change in direction. Doji candlesticks are characterized by thin bodies and long wicks, signifying indecision and potential reversals. These patterns suggest a market pause or hesitation before a possible move in either direction. Spinning top candlesticks also feature thin bodies and long wicks. But unlike dojis, they have short wicks compared to their height, indicating indecision and the possibility of a directional change. Recognizing these patterns helps traders adapt to market changes and make informed decisions. Reversal star candlesticks are a category of patterns found in price chart. These patterns consist of 3 candlesticks, with the central candlestick known as the star, which gaps away from the other 2. The star can be either bullish or bearish and is set apart by the gaps, which is why it gets its name. The first candlestick aligns with the existing trend, the star signifies uncertainty, and the third candlestick suggests a possible reversal. Typically, the star is smaller than the other 2 candlesticks, indicating a pause or deceleration in the previous trend. Inside bars are traded in alignment with the prevailing trend and are commonly known as breakout plays. These patterns indicate a phase of consolidation within a market. They typically emerge after a significant market movement, serving as a pause before the next direction is taken. Additionally, inside bars can signal a potential market reversal at critical support and resistance levels. Rising and falling window patterns provide a visual representation of market sentiment. A rising window forms when the lowest price of a period is higher than the highest price of the preceding period, creating a gap or window in the price chart. Conversely, a falling window emerges when the highest price of a period is lower than the lowest price of the prior period, again forming a window in the chart. These gaps indicate strong buying or selling pressure. The 3 soldiers. Pattern forms when the price action consists of 3 consecutive long-bodied candles that close near their highs with little or no wick. This suggests buyers are in control and bidding the price higher. This pattern can imply that an existing downtrend may reverse as buyers gain control. Similarly, 3 black crows consist of 3 consecutive bearish candles, indicating that sellers are taking over. As with any technical analysis indicator, these patterns should be combined with other signals to confirm trends. Identifying trends allows traders to align their strategies effectively with market movements for better outcomes. Utilizing price action signals in the same direction as the trend can enhance entry and exit opportunities. Uptrends are defined by a series of higher highs and higher lows, indicating bullish market sentiment. Downtrends feature lower highs and lower lows, signaling bearish conditions and potential declines in asset prices. Trading with the trend increases your chances of making successful trades and maximizing profit potential. Support and resistance are key levels to understand. Support is a price level where buying interest is strong enough to prevent the price from falling further, acting like a floor. Resistance is a price level where selling pressure is strong enough to prevent the price from rising further, acting like a ceiling. Traders use these levels to identify potential entry and exit points, as prices often bounce off support and resistance or break through them, signaling a possible trend continuation. Indicators serve as tools to confirm trading decisions, providing insights into market conditions and trends. They are best used to validate trends and identify potential reversal points. One of the most widely used indicators is the Moving Average Convergence Divergence, or MACD. The MACD combines moving averages with momentum to indicate both the strength and direction of market trends. When the MACD line moves above zero, it signals increasing bullish strength, whereas dropping below zero suggests intensifying bearish pressure. A bullish signal is generated when the MACD line crosses above the signal line, while a bearish signal occurs when it dips below. Traders often combine the MACD with support and resistance levels in candlestick charts for optimal results. It's also important to watch for divergence. Sometimes a trend may appear strong, but if the price reaches new highs or lows without corresponding MACD highs or lows, this signals a potential loss of momentum and a possible trend reversal. Next, let's talk about moving averages, which are perhaps the most straightforward and widely used trend indicators. The two most common types are the simple moving average, or SMA, and the exponential moving average, or EMA. The simple moving average calculates the average price over a set period by adding all closing prices and dividing by the number of periods. This helps reduce false signals as all data is treated equally. The exponential moving average, in contrast, gives more importance to recent price data, allowing it to react more quickly to new market developments. However, relying solely on the EMA can make trades vulnerable to false signals. Here's how moving averages help identify trends. When a price rises above a rising moving average, it suggests an upward trend. Conversely, when a price falls below a declining moving average, it signals a downward trend. Moving averages also frequently act as support and resistance, where prices often change direction after pullbacks. Crossover signals are particularly important. A bullish golden cross occurs when a shorter-term moving average surpasses a longer-term one, for example. When the 50-day crosses above the 200-day. Conversely, a death cross signals a bearish outlook. Happening when a shorter-term moving average falls below a longer-term average. The Relative Strength Index, or RSI, is another key momentum indicator. It measures the speed and change of price movements on a scale from 0 to 100. An RSI above 70 typically indicates an overbought condition, suggesting a potential price correction. An RSI below 30 signals an oversold condition, which may be a buying opportunity. RSI can also confirm trends. It generally fluctuates between 50 and 80 in strong uptrends, and between 50 and 30 in strong downtrends. Divergences between price and RSI can indicate weakening momentum and a potential reversal. Volume is another essential indicator for evaluating market strength. High trading volumes usually signify strong trends, while low volumes may indicate a lack of interest and potential reversals. Sharp increases in volume can lead to gap-ups or breakouts, indicating momentum. Conversely, a surge in selling volume can create reversal patterns like the shooting star, followed by gap-downs. Understanding volume helps traders gauge trend strength, exhaustion, and potential breakouts. While indicators are helpful, they are not perfect. Many are lagging, giving signals after a move has already started. That's why it's crucial to combine indicators with real-time price action. Use them as confirmation tools, not as sole decision makers. Next, I want to show you the most common chart patterns. This is another tool to help predict price movements. These visual formations illustrate the ongoing battle between buyers and sellers and provide insight into market sentiment. By learning the different types of patterns, their characteristics, and practical applications, traders can improve accuracy and make informed decisions. Now let's discuss risk management, which is one of the most critical aspects of trading. The mantra is win big, lose small. Define your risk on every trade and stick to it. Traders should determine a specific risk percentage for every trade to protect their investments and manage their capital wisely. Stop-loss orders are essential for safeguarding trading capital from unexpected market fluctuations. Position sizes should be calculated according to the target of the pattern and your risk tolerance before entering a trade. This approach reduces stress, panic, and fear of loss. Understanding market psychology is equally important and often overlooked by beginner traders. The Wall Street cheat sheet highlights the emotional stages traders typically go through during market cycles: disbelief, hope, optimism, excitement, thrill, euphoria, anxiety, denial, fear, desperation, panic, capitulation, anger, and depression. Recognizing these stages can help traders anticipate market behavior and avoid emotional traps. In the early stages of a trend, disbelief is common. Traders may doubt the market's move and hesitate to enter positions. As the trend continues, hope and optimism grow, leading to excitement and eventually euphoria. At this stage, traders may take excessive risks, ignoring fundamentals or their own trading rules. Conversely, when the market starts to reverse, emotions shift rapidly. Anxiety and denial occur first, followed by fear and desperation as losses mount. Panic and capitulation often follow, where traders exit positions impulsively, locking in losses. Finally, anger and depression can set in, leaving traders frustrated and less confident in future trades. The key takeaway is that most traders experience these emotional cycles, and falling into them can lead to repeated mistakes. By understanding these patterns, you can identify when your own emotions might be influencing decisions. Learning to recognize early signs of fear or greed allows you to stick to your plan rather than reacting impulsively. Practical strategies for managing emotions include taking regular breaks from the screen, maintaining a trading journal to track decisions and feelings, setting strict risk parameters, and using stop-loss orders to prevent catastrophic losses. Combining these approaches with disciplined strategy execution helps traders remain objective, even during periods of high volatility. Ultimately, mastering market psychology gives you a significant edge. Traders who can control their emotions and act logically rather than emotionally are far more likely to achieve consistent results. Emotional discipline is not optional. It is the foundation for executing strategies successfully and maintaining long-term profitability. Mastering these principles from candlestick patterns, trends, risk management, and emotional control will help you become a confident and consistent trader or investor. Stay disciplined and patient. And remember that consistent application of these strategies is what separates successful traders from the rest. Thanks for watching Pipeline Trading. Happy trading, and God bless you.